Welcome back. If this is your first time joining us, this is Epic Investing Nerd, a guide to investing in financial wellness by a young dorky millennial for young dorky millennials, or dorky boomers, or dorky Gen Xers, or just beginners, or experts who want to review investing basics because, hey, why should I exclude anyone? So in this video, guys, we're going to talk about the differences between investing and speculation. Hopefully you saw my previous videos about saving money and how to tell whether you're ready to invest or not. If you're not sure if you're ready to start investing yet, go ahead and watch my previous video. I'll put a link below. But let's assume you have some money saved up and have no high-interest debt, and now you're ready to invest. Well, before you buy, you should understand that not all assets are necessarily investments. Just because you buy something that you think will earn you money later doesn't mean you've invested. See, many people think they're investing and buying and selling investments, when what they're really doing is speculating. Some assets should not be called investments, no matter the circumstance. But even assets that are investments could just be speculations depending on how and why you buy. If that's confusing at all, here's a visual to help explain what I mean. Investments are assets that generate cash over time. This includes stocks, bonds, and some kinds of real estate like farmland or rental property. Assets that are pure speculations generate no cash on their own. You're only buying them because you believe you can sell them at a higher price. These include commodities like gold, silver, or oil, foreign currencies, cryptocurrency, art, collectibles, etc. Residential real estate that you don't plan to live in but just plan to sell later is pure speculation and not at all an investment. Anything that you buy with the sole intent to sell at a higher price is not an investment, it's a speculation. Because of this, stocks, bonds, and real estate, which would otherwise be investments, could be pure speculations depending on why you're buying and how long you plan on holding for. Speculators trade way more frequently than investors. For this reason, speculators are also called traders. Some traders hold stocks or bonds for less than a day. We call these especially active speculators day traders. In short, speculators buy just to sell higher. Investors, in contrast, are buying their own source of income. That's basically what investing is. It's buying a source of income. If the market value rises, great, but that's not the primary reason they purchased. They didn't buy it just to sell later this month or this year or perhaps ever. They bought it because they wanted the stream of cash that it produces. They wanted the underlying business itself. So what you're saying, nerd, is that investing is better than speculating? Overwhelmingly, yes, that is what I'm saying, but there are some exceptions to the rule. Here's a nice nerdy example of speculating wisely. While visiting a yard sale, Jeff notices a box full of old Magic the Gathering cards. Now, Jeff doesn't play Magic himself, but he has several dorky friends who do, and he knows some of these old cards can sell for hundreds and sometimes even thousands of dollars. So he takes a look, and lo and behold, he sees a real Black Lotus card, one of the most coveted cards in the game. A mint condition Black Lotus is worth $87,000, and the oblivious owner of the yard sale is selling each card in the box for only 10 cents each. The price discrepancy between 10 cents and a possible $87,000 is too great to ignore, and Jeff wisely buys it along with several other cards. Now bear in mind, Jeff doesn't play Magic himself. He has no use for the card other than to resell it, and the card itself does not generate cash or goods, obviously. Jeff has not invested, he's speculated, but he has speculated wisely because he knew what the seller didn't. Compare Jeff's speculation with our next hero's investment. Nathan has no debt and has been saving some money for some time. Before, he'd considered buying Coca-Cola stock. It's a strong company offering timeless products, but Nathan concluded it might be overvalued. Then, as luck would have it, a Coca-Cola advertisement features an athlete who's been critical of President Trump. In response, Donald Trump tweets,
"Coca-Cola, failing company, only keeps their recipe secret because it really contains aborted fetuses and burning flags. Brown like the stew engine is. Sad."
In response, enough investors get spooked that the stock price plummets. Now, Nathan is all but certain that those aren't really the ingredients to Coke and that the tweet won't hurt Coca-Cola's long-term earnings. He doesn't know the future, but he does know that Coca-Cola and its tasty dividends are now on sale at a discount. Will it go back up or continue downwards for a while? Nathan doesn't care. He's not going to use the money for several years anyway. He's not buying Coca-Cola stock just to sell it later. He's buying it because he loves Coca-Cola and its products, and he wants to divert some of Coca-Cola's earnings to himself. So there you have it. The difference between investments and speculations. Knowing the difference means knowing yourself. I'll leave you with this passage from Jason Zweig's annotation in The Intelligent Investor by Ben Graham, who I will definitely be covering in later videos. Add it all up, and a stock trader needs to gain at least 10% just to break even on buying and selling a stock. Anyone can do that once, by luck alone. To do it often enough to justify the obsessive attention it requires, plus the nightmarish stress it generates, is impossible. Thousands of people have tried, and the evidence is clear. The more you trade, the less you keep. The term long-term investor is redundant. A long-term investor is the only kind of investor there is. Thank you for watching until the end. Go ahead and hit those like and subscribe buttons so I can generate some web traffic over here.